In September 2022, the British pound collapsed in 4 hours, not over weeks, not during a war or a banking crisis. 4 hours. The trigger wasn't a terrorist attack or a natural disaster. It was a PDF, a mini-budget announcement from the new Prime Minister promising tax cuts funded by borrowing. The market read it, did the math, and decided the UK government was lying to itself. Pension funds started failing by lunchtime. The Bank of England had to intervene before dinner. And here's the part that should bother you. The people who crashed the pound didn't break any laws. They didn't hack anything. They just moved money. Faster than the government could react, faster than regulators could meet, faster than the public even knew what was happening. This isn't a story about one bad day in Britain. It's about what happens when the speed of capital outpaces the speed of governance. And it's happening everywhere, all the time, in ways most people never see. For most of human history, money moved slowly. If you wanted to move gold across borders in the 1800s, you physically shipped it on boats. If you wanted to collapse a currency, you needed armies. Economies had time to adjust. Governments had time to respond. There was friction built into the system. That friction is gone. Today, a hedge fund in London can sell yen 1 trillion, buy dollars, and short the Japanese government bond market before you finish reading this sentence. High-frequency trading algorithms execute thousands of trades per second. A single tweet from a central banker can trigger billions in capital flows before the press conference ends. Speed has become the defining feature of modern finance, and speed creates power. The problem is this: money now moves at the speed of light, but governments still move at the speed of committees. Parliaments need weeks to pass legislation. Regulatory agencies need months to investigate. International coordination takes years. Meanwhile, capital is already gone, already repriced, already betting against you. This isn't a theoretical concern. It's the structure of the global economy right now. And it's creating a world where markets don't just react to government policy, they overrule it. Let me show you how. Start with the basic architecture. There are roughly $200 trillion in global financial assets. Stocks, bonds, currencies, derivatives, real estate, commodities. All of it interconnected through a network of banks, brokers, exchanges, and clearinghouses that operate 24 hours a day across every time zone. Most of this money doesn't belong to individuals. It belongs to institutions, pension funds managing retirements for millions of people, sovereign wealth funds representing entire nations, insurance companies holding reserves against future claims, hedge funds and private equity firms managing money for the ultra-wealthy. These institutions don't invest based on hope or patriotism. They invest based on risk-adjusted returns. And they can move. If a government announces a policy that threatens returns, higher taxes, unsustainable deficits, capital controls, nationalization, the money leaves. Not eventually, immediately. This is where the speed matters. In 1992, George Soros famously broke the Bank of England by betting against the pound. He made $1 billion in a single day, but that trade took weeks to set up. He had to borrow pounds, convert them to other currencies, wait for the Bank of England to exhaust its reserves trying to defend the peg, then close the position. Today, that same trade happens in milliseconds. Algorithms scan central bank statements for specific phrases. They parse inflation data before human analysts even open the file. They detect changes in bond yields, correlate them with currency movements, and execute positions across multiple markets simultaneously. The result is something close to perfect efficiency, which sounds good until you realize what it means. There is no grace period anymore. No time for a government to clarify a statement, walk back a policy, or coordinate a response. The market has already moved. The damage is already done. And here's the uncomfortable part. This system makes crises worse, not better. Let's walk through what happened in Britain, step by step, because it's a perfect case study. Liz Truss becomes Prime Minister. She wants to cut taxes and boost growth. Sounds reasonable. The problem is the UK is already running a deficit and inflation is near 10%. Her plan requires borrowing billions more at a time when borrowing is expensive and risky. The market looks at this and sees a government that doesn't understand its own constraints. So they sell. Not just British government bond yields, but the pound itself. Because if the government is going to borrow recklessly, inflation will rise, the currency will weaken, and bondholders will lose money. Better to get out now. But here's where it spirals. UK pension funds weren't just holding gilts. They were using a strategy called liability-driven investing, or LD. Essentially, they were using derivatives to hedge long-term pension obligations. These derivatives required collateral, and when gilt prices fell, the funds had to post more collateral immediately to raise that collateral. They had to sell more gilts, which pushed prices down further, which required more collateral. A feedback loop. Within hours, some of the largest pension funds in Britain were facing margin calls they couldn't meet. If the Bank of England had UNC stepped in and started buying gilts, effectively printing money to stabilize the market, the entire pension system could have collapsed, all because capital moved faster than the government could adjust its policy. Now, you might think this was a unique failure. Bad policy, bad timing, bad luck. But it wasn't unique. It was inevitable, because the same structure exists everywhere. Debt markets in the US, Japan, Europe, currency pegs in emerging economies, sovereign bonds in countries with fragile finances, all of them vulnerable to the same dynamic. If capital decides you're a bad bet, you lose control, and the speed makes it impossible to fight back. Governments like to talk as if they're still in charge. Central banks give press conferences, finance ministers announce stimulus packages, regulators write rules about capital requirements and leverage ratios. There's a whole theater of authority. But watch what happens when that authority is tested. In 2015, China tried to prop up its stock market by banning selling. It didn't work. Capital found other ways out. In 2018, Turkey tried to stop a currency crisis by threatening to punish speculators. The lira collapsed anyway. In 2020, Lebanon defaulted on its debt despite having a central bank, a finance ministry, and decades of international support. The money just left. The pattern is always the same. Government announces policy. Market evaluates it. If the market doesn't believe it's sustainable, capital flows reverse. And once that reversal starts, there's no stopping it with speeches or regulations. This isn't because governments are weak. It's because the system is designed to allow capital to escape constraints. Think about it structurally. A government can control what happens inside its borders up to a point. It can tax income, regulate banks, set interest rates. But it can't force investors to hold its bonds. It can't stop a pension fund from diversifying into foreign assets. It can't prevent a corporation from moving profits to a lower tax jurisdiction. Capital is global. Governance is national. That asymmetry is the entire problem. And it's not just about finance, it's about power. When capital can move faster than governments can act, capital makes the rules, not through conspiracy or corruption, but through pure economic logic. If you make money cheap and returns high, it flows in. If you create risk without reward, it flows out. Governments that understand this survive. Governments that don't, fail. The UK learned this in 4 hours. Other countries will learn it slower, but they'll learn it. So where does this go? One possibility is that governments adapt. They coordinate more, they move faster, they build systems that can match the speed of capital flows, real-time fiscal policy, algorithmic regulation, centralized digital currencies that can't be moved without permission. Some of this is already happening. Central bank digital currencies are in development in dozens of countries. Financial surveillance is more sophisticated than ever. Governments are experimenting with capital controls that are harder to evade. But this creates its own problems. Because if governments match the speed of capital by becoming more centralized and automated, they also become more fragile. One wrong algorithm, one bad decision at the top, and the whole system locks up. There's no redundancy, no time to deliberate. The other possibility is that capital just wins, not through some dramatic collapse, but through a slow erosion of national sovereignty. Governments become administrators of whatever policy keeps capital from leaving. Taxes stay low on the wealthy because high taxes cause capital flight. Deficits stay manageable because bond markets demand it. Regulation stays light because strict rules push business elsewhere. This isn't hypothetical. It's already the reality in much of the developed world. Look at corporate tax rates over the past 30 years. They've fallen almost everywhere, not because voters demanded it, but because countries compete for investment. Look at financial regulation after 2008. Stricter in theory, but in practice, the biggest banks are bigger than ever. Look at monetary policy. Central banks are terrified of raising rates too fast because it might trigger a market crash. The message is clear. You can govern, but only within the boundaries capital allows, and those boundaries keep shrinking. Here's what keeps me up at night. The system we've built is optimized for speed and efficiency, and it works most of the time. Capital flows to where it's needed. Markets price risk. Inefficient governance get punished. Efficient ones get rewarded, but speed and efficiency are the opposite of resilience. A system where everything moves instantly is a system where shocks propagate instantly, where one failure in one market spreads to every connected market before anyone can react, where there's no time to think, no room to maneuver, no ability to contain damage. We saw this in 2008. Lehman Brothers collapsed on a Monday. By Friday, the entire global financial system was on the edge of freezing, not because every bank had bad assets, but because nobody knew who was safe and who wasn't. And in that uncertainty, capital fled everything. It took trillions in government intervention to stop it. And that intervention only worked because governments still had the capacity to act. What happens next time, when the crisis moves even faster, when algorithms are making the decisions and humans are just watching, when capital has already moved before anyone realizes there's a problem, I don't know, and neither does anyone else, because we've never stress-tested this system at full speed. So here's the thought I'll leave you with. We live in a world where money moves faster than democracy, faster than law, faster than the institutions we've built to manage collective risk. That gives capital enormous power. Power to discipline governments, power to reward efficiency, power to punish mistakes. But power without accountability is just force. And a system where force moves at the speed of light, while accountability moves at the speed of parliament, is a system that will eventually break something important. Maybe it already has. Maybe we just haven't noticed yet. Because the thing about speed is, by the time you see the crash coming, it's already happened.